Hi all and welcome to a special broadcast from the team at Sharon Partners. I'm joined once again by Dr. Steve Garth from Manly virtually. Thanks for joining us again, Steve. And we thought it was an opportune time with a big year in financial markets in 2020 to have a look back and dive a little deeper and explain what we saw happen, where things went, and no better place to start with that than by throwing over to you, Steve, to give us a broad overview of the performance of the different asset classes.
Yeah, thank you, Billy, and welcome everybody. Look, despite the Australian share market dropping to its lowest point in 8 years in mid-March when the pandemic first hit, it's actually been a rather remarkable rally through April all the way through to the end of the year, and in fact continuing. And what that means, though, by the end of the year, the market's kind of on par with where it started. And it's also been a huge year for the US market as well. That continues to be on a run. So let me just show you the performance of different asset classes over the year. First thing is just to point out that bonds, we all know that yields are at essentially record lows, essentially around 1% if you're buying bonds. And yet you can see that yields have fallen over the year, meaning that the bonds have actually done quite well compared to cash. So while Australian cash is returning about 0.1%, you can see that both Australian bonds and global bonds are returning around 3 to 4%. Australian market, as I mentioned, has returned flat for the year, just up by 1.7%. Global markets have done really well, and emerging markets have actually beaten the global markets for the first time in a little while. REITs, real estate investment trusts, are no surprise. They've been the worst asset class over the year, both in Australia and globally. They've been beaten down by people working at home.
Yeah, I note there that you mentioned that the strong performance of global markets, and of course the US is the biggest contributor to the performance in global markets, being such a large part of that, and the underperformance of Europe and to a lesser extent Australia. Can you give us a bit more detail on that, Steve?
Yeah, so the chart I've got up now is another chart of just index data. This one shows Australia being a little bit down for the year. It's a different index. When you look across the Euro market, that's got a negative for the year, and that's probably no surprise. Not only that they really being beaten down by COVID, but of course, particularly in the UK, I think that's down about 14% for the year. That's had the overhang of Brexit all year. And then we come to the US market with the extraordinary performance that the US market's been on, maybe one of the greatest bull runs ever. It just seems to keep going up. And if I dig a little bit deeper into that, Billy, the chart I've got up now shows over the last year the Australian and the US market, and obviously the US market doing a little bit better. But if we have a look at the drivers of the US market, it's this group of stocks which are affectionately known as the FANGs, which is an acronym for Facebook, Amazon, Apple, Netflix, Google, and there's a few other stocks in there too, such as Tesla, which is up a remarkable 750% for the year. But the FANG index, a collection of FANGs, it's up 100% for the year. And they make up a big part of the US market. They make up about 25% of the US market. So that's really been driving that outperformance of the US market over the other markets.
Thanks, Stephen. You note there that those FANG-style stocks make up about 25% of the US market. If we come back home to Australia and look domestically, can you tell us how the makeup of the Australian market looks? What the key components are there?
Yeah, so here's a chart I've got up now, Billy, and maybe just looking at the right-hand side at the moment, it's a pie chart. Just tried to collect, the major industries that make up the Australian market, and you can see that financials make up close to 40% of the Australian market, followed by the non-energy minerals sector. And then when I look at the left-hand side, the bar chart, it's representing how those different sectors performed over the year. And I mentioned earlier in the commentary that, it's kind of a tale of two cities. Financial and transport have been beaten down, while technology and health services have done quite well. And you can see that in the chart, But I think the big difference, even though technology services in Australia have shot the lights out, think of Afterpay, for example, in Australia, it's a very small part of our market. And so while technology services have done really well in Australia, it's sort of not enough to really tilt the needle very much, where the finance, which has been beaten down, first of all, by the Hayne Royal Commission in 2019, and then being hit by the pandemic with the potential bad loans being priced in there. When they make up 40% of your market and they've got a negative return, that's obviously going to affect the overall performance. Health stocks have done well, retail trade has done well, and that's a little bit, while we've been in the pandemic, people can't spend money on tourism, so they're spending a lot of money at home. So it's actually been quite a good year for the retail sector. And just in the last 6 months, we've seen quite a boom in the commodity market. And so the non-energy mining sector is doing quite well out of that.
Thanks, Steve. A great, comprehensive review of what's happening in markets, and also great to hear a little bit of intel in terms of what's been driving some of that performance. So I appreciate that, and I'm sure our viewers will as well. Moving on from the financial side and looking at what we've seen in markets in 2020, what can we take away? What do you think we can take away from the year that was?
Yeah. Well, I think there are things we can take away from a social perspective, from an economic perspective, and then from a financial perspective. So from a social perspective, you'd have to say, and from a health perspective, while everyone hates lockdowns and social distancing, there's no question that it works. The other social thing that I think would surprise some of the big bosses, but actually working from home has actually seemed to be quite productive. And basically been good for the environment, cut down on travel, and it contributes to a more balanced life. And so you expect there'll be some measure of working from home that was migrating that way for many companies over the last few years. But I think the pandemic has pushed it for many companies now to realise, it's not such a bad thing. From an economic perspective, there's no doubt that governments have realised, or the smart governments have realised, that recovery is going to be fastest if you can protect businesses, jobs, and income. And I think once again, Australia and New Zealand have done a very good job of that. And from a financial perspective, the thing that is so important, and it really comes out of 2020 when we saw in late February and early March how that market was falling, and there was a panic, understandable panic setting in for many investors. But again, with the way the years planned out, when you go back and look at those asset class charts we've seen, the US market's got a higher return than its average over this year. And so what that tells all investors is that a diversified and disciplined approach to investment is always the best way to go. Don't go changing investments based on short-term news, no matter how drastic that news might be.
Yeah, absolutely. Couldn't agree more. Very sound. And I, going from what we've learned to what may lay ahead for the economy and for financial markets, what might we reasonably expect from where we sit at the moment?
Yeah, well, it's always hard making predictions. And as Yogi Berra once said, it's very hard making predictions, particularly about the future. But if I could make a couple of safe predictions about the year we're in, 2021, there's no doubt that we're going to see a continuing macroeconomic recovery. And that's really is helped by the massive policy stimulus that we've seen up till now. And of course, we're just recording this today after the US presidential inauguration. And again, that policy stimulus is continuing in the US as well. This, along with continuing low inflation and low interest rates, we're likely to see positive returns from the stock market. And that's basically built on where else can you invest? If you're not getting a return from cash, then people are probably going to keep supporting the stock market. One can certainly expect low returns from bonds and of course cash, but keep in mind that highly rated bonds will probably still be a very good defensive mechanism against the volatility of equities. And the last thing, as I mentioned before, but it really is so important when it comes to investments, stay diversified and stay disciplined. Speak with your financial advisor about the portfolio that's right for you and stick with it.
Thank you, Steve. Appreciate your time and your knowledge as always. Thank you for sharing it with us, and look forward to seeing you again soon.
Terrific. Thanks, Billy. See you soon.